Hello and welcome to the latest edition of the Resilient Investor Podcast. My name is David Stevenson.
Joining him is Sam Ridley.
Hello Sam, how are you, mate?
Very well, thank you, very well. Good to be back. Sorry for the break.
Absolutely, we've been busy, lots of stuff going on in the markets, all that kind of stuff. We're going to talk a little bit about, what are we talking about? We're going to talk a bit about different international markets for its shares.
Yes, and I had a question for David. Hopefully he'll be able to answer is, are UK stocks a good place to be or find value from at the moment?
We're going to talk a little bit about, you've got a question, haven't you?
Yeah, personal one. Should I be investing in bonds?
Very, very good
Not
question.
something I do at the moment, so I'm interested to hear more.
No, and actually a lot of younger people, you are a younger person, not as young as we all once would like to be. Anyway.
It's not what my dating profile says.
A lot of people don't invest in bonds, and actually it can be a daft thing, actually. And I was going to mention an investment idea to look at is about REITs.
Yes.
Yeah, they are real estate investment trusts. And that was actually then also finally going to finish is what's the difference between an investment trust and an ETF?
Nice.
That's good.
Looking forward to that.
Yeah. Okay. So why don't we ask your question first, Sam?
So as a resilient investor,
Yep.
should I be investing in bonds? If so, what, how, where? Just want to learn more about that really from a personal.
So why have you thought about not investing in bonds in the past, or have you just not given it any thought?
Two reasons. Upside potential or value of return. You know, I'm more risk on, so I tend to pick equities over something like bonds. But after our previous discussions on diversifying, I'm now thinking I need to diversify. Also, probably just seemed a little bit too complicated for me compared to understanding if a company's worth investing in. Bonds, to what I know, have more market influences at different times of year. A little bit more academic, I suppose. Yeah. And as to a new investor, it's something I haven't taken the time to learn more about until now.
Okay, well, an interesting small factoid, it will probably put most people to sleep, is that there's this organisation called Nest, I've probably changed its name now, but which is the auto-enrolment pension.
National Employment Savings Trust.
That's right, yeah, and it's a kind of auto-enrolment scheme. And they did a big survey many years ago, and they actually looked at whether or not people in their 20s who didn't know a lot about investing should be invested in bonds, yeah? Okay. And what was interesting is they found out the answer was yes, and their argument was that a lot of younger people, when they start investing, they quite often time it poorly, yeah, and then they run into a stock market fall, yeah, and then they exactly, yeah, hello, you're pointing fingers.
I have a confession to make.
Hello, Sam, would that be you? And they then get scared of investing, yeah, and they get put off it for life, yeah, right. Because effectively, once burnt, yeah. And they found actually quite a good way of doing stuff is actually putting a small amount into bonds at the beginning in their 20s, and then seeing how they react to risk and then moving on. And there are two other ways of thinking about bonds as well. Bonds also can sometimes just be a damn good investment, yeah. Now you might ask, when would they be a good investment?
When would they be a good investment, David?
That's
Thank
amazing.
You for the tee up there. There was a slight delay because
exactly.
Reading the room.
They might actually be quite a good investment in the next year or so. And the reason for that is it's just the relationship between so a bond is effectively an IOU. Yep. So Sam Ridley Enterprises sets himself up. They then borrow £100 from David Stevenson Investing Company. You say, I'll repay my £100 in 5 years' time. And
sounds like the Bank of Dad. Sorry,
I would like to point out I'm not your dad. I know. But, moving that off subject. Anyway, exactly. But the Bank of Dad never gets their money back. Anyway, So actually, with bonds, you do get your money back. So I lend it to you for £5. Sorry, 5 years, £100, and then I say I'm going to be paid a coupon, my interest rate. Yeah. Now, let's for argument's sake say if we'd issued a bond a few years ago, even a year ago, it would have been a low interest rate, say 1%, because that's what interest rates were. So I'd pay you £1 every year for the next 5 years, and then I'd pay you £100 back. All right. Okay. Now, when interest rates go up, that £100 bond, which pays you 1%, doesn't look as attractive. So therefore, the value of that bond goes down. Yeah. Oh, right. So effectively, in potentially, it wouldn't work out this way, that if interest rates went up to say 5%, and they're probably heading to 5% as we speak, that bond might only be worth, do the math, it might be worth 20 quid. on the market value. Yeah, it won't actually work out that way because of the way things work. Because actually, if it's worth 20 quid and you're getting paid £1 a year in interest, £1 on £20 is a 5% return. Now, it doesn't work that way, and it's more complicated than that, because actually you know damn well that you'll get your £100 back in 5 years' time. So you also sort of do an exercise where you work out what your money you're going to get back. So it won't be 20 quid. But the point about it is that if interest rates go up, and the reason interest rates go up is because of inflation, because central banks will worry about inflation. To stop inflation, they'll put interest rates up. As interest rates go up, the value of many bonds, including government bonds, goes down. And quite often that can overreact, just as it can with stocks and shares and equities. And the value of bonds can fall so much that actually they become reasonably good value, particularly if you know you're going to get repaid at the end, yeah?
It seems to me, making sense, it seems like a strategy to utilise with larger amounts of capital.
Not
necessarily. Because of the percentage return rates and things like that?
Not necessarily. Okay. You can buy bonds just like you can buy shares.
Yep.
Okay, so you don't have to... I mean, if you went to the government, the government's not going to sell you shares unless you buy 100,000 quid or a million quid's worth of shares. But you can go to an ordinary stockbroker and just say, I'll buy...
for example, on my platform?
Yeah. Any big platforms. You can buy government securities. They're called gilts, yeah?
Yep.
And you can even buy some corporate bonds. You can even buy some retail bonds. Retail bonds are always sold to ordinary investors. Yeah, they could be, I don't know, retail bonds are issued by people like Lend Invest, lots of smaller companies.
Okay.
So you can buy bonds just like you can buy shares. Now, what I was trying to get at is they can make quite a lot of sense if interest rates go up, and then you think that interest rates at some point in the future are going to go down. Because just as I explained, with interest rates going up, a bond suddenly becomes less valuable because of that stream of income payments. If interest rates go down...
More valuable.
They become more valuable, exactly.
Mr. Bond.
Yeah, Mr. Bond. And in fact, the story of the last 20 to 30 years is, as interest rates are generally headed down, bond investors have made an absolute killing. Yeah. Now, they've not made as much money as, until recently, tech investors have made. They've made large amounts of money. Yeah. But bond investors did really well. Yeah, okay. They made absolute stackload of money. So bond investing can make sense. The problem with bond investing is that you, in order to do the strategy I talked a bit about, you've got to have a view about interest rates.
So would you say the recent market has meant bonds traditionally perhaps seen as a safe haven over a longer period of time because interest rates have been falling?
Yeah.
And there are probably many companies out there who've made their bonds as a safe haven to investors. They've had a sharp reality check with interest rates rising so quickly.
And they've been caught.
But technically, it's not the firm's fault. It's we're in one of those bear markets that is long awaited.
Yeah.
So this. Okay,
so
what I've been seeing in the media more is the bonds have been actually at times attracting a negative.
Yeah, and in fact, if you'd have basically, let's say you'd had 100,000 quid and you stuck it in a wide variety of bonds a year ago, you'd be sitting on huge losses now because you've been absolutely caned. Yeah. Now that can turn though, because the thing about investing is that for every negative there's a positive. So when you think interest rates have basically hit their peak and are going to come down, bonds could be a brilliant investment. And one last area that bonds can make some sense in, well, actually a couple of last areas. One area is, let's say you've got cash, and we all know that if you put your money on a cash account at a stockbroker or frankly at a bank, you get diddly squat interest rate. You could, for instance, invest in what we call short duration bonds. These are bonds that are paying out in, say, a year's time, 6 months' time, year and a half's time, 2 years' time. Probably the government, but you could also invest in like big companies, a company like Vodafone, it's not going to go bust in the next couple of years, And if that bond is maturing, that means it's being paid back in a year or two's time. Your risk of losing that money is very low. I mean, not zero, but very low. And if it's the government, zero, because the government ain't going to go bust in the next couple of years. So actually, if you want to hold some cash, for the next year or two, bonds could be an interesting place.
Interesting. Good explanation.
And then the last area of bonds can make sense.
I do have one thing on that before you go to the last area. It's well known to me that, for any of my stock positions that have taken a battering, for every 10, 20, 30, 50% I'm down to get back up to my original position. We're trebling, doubling, quadrupling, whatever the figure may be. Does it work in the same case as a bond? So bond is a percentage point down or half a base point?
Well, I mean, it still has a numerical relationship.
Okay, fine.
But, bonds by and large don't go down by as much as equities. So it's unusual for bonds to go down by more than, say, 10, 20, 30% on average across a portfolio.
Right.
Yeah, probably 15 is probably an average, 10, 15.
Okay.
It's not remotely unusual for equities to go down by 15%. In a year. Well, they could go to zero. Yeah.
Yes.
So they are not as volatile. And I just wanted to mention one last area where bonds are relevant. It's not necessarily relevant to you as a young man, more relevant to me as an older man. Is that bonds could be very good if you basically want a defined profile.
Okay.
So let's just say I'm in my 50s, let's say 60s, and I'm retired. I don't want to take a lot of risk, yeah? And I might carry on buying bonds and recycling them into bonds and just use the income from the bonds to pay for my retirement. So bonds can make sense for a particular type of a lower risk investment who wants an income. So there's lots of reasons why bonds be interesting. Bonds could be interesting because they educate you about risk. Bonds can be interesting because they can actually make a really good return if you can make a good call on interest rates. They can be a good alternative for cash, and they can work for other investors.
So good for a balanced portfolio, diverse balanced portfolio?
Well, no, and that I think is the flaw I pick up, which is a lot of people have this idea that you have a 60-40 portfolio.
Yeah.
60% shares, 40% bonds.
Correct.
And by and large, over the last 20, 30 years, that's done you really well.
Mm-hmm.
It hasn't the last year. It's been an absolute frigging disaster, yeah?
Right.
And in fact...
All but rewritten then.
Yeah, so Vanguard had a very successful kind of portfolio that looks a bit like that in their life strategy products, which are great products, nothing wrong with them. And it's had probably one of its worst years ever, yeah, because the bonds bit just basically collapsed and the equities bit collapsed at the same time, which is one of the problems. They both went down, yeah.
Okay, something to watch out for, but very interesting. Thank you, David.
That's right. Now, you were also going to ask me about REITs, weren't you?
Just a little bit about REITs. I mean, I remember through the lockdown period, there was a lot of talk about it, particularly because of the work from home, shop from home, delivery.
Yeah.
There were a lot of REITs focusing on the warehouses.
Yeah. Logistics.
Logistics, that's quite right. There was one called Tritax.
Tritax Big Box.
Yeah, which I put a little bit of money into, I must say. Every stone has been turned. and all the rest. So I just wanted to learn more, much like we've just done with bonds, really to understand more about REITs, where they're used in portfolios, how are there opportunities at the moment for our readers out there to be
short answer
listeners,
is,
not readers.
Yes. Short answer to that at the moment is no.
Okay.
And it's also probably interesting to compare a REIT, which is an investment trust, with an exchange-traded fund.
Yep.
But let's just take them in turn. So a REIT is a real estate investment trust, and it invests, as you said, in property, real estate. And there are lots of different types of REITs. Yeah. There are REITs invested in logistics companies, which is big box retail. Big box, Tritax big box. There are REITs that invest in commercial property. Mm-hmm. Yeah. There are REITs that invest in social housing. There are REITs that invest in ordinary residential. So REITs they are very popular in America. Lots of big REITs in America, and lots of big REITs in the UK. You also have kind of property companies like British Land, which isn't really a REIT. It's a property company, but looks and feels a bit like a REIT. So,
do emerging markets have REITs?
Yeah.
Okay,
Emerging markets. In fact, one of the funds that I look at is this thing called the Grit Real Estate Investment Trust. And they invest in Africa, and they've got prime office in lots of big African cities. Yeah, okay. And really blue chip clients like the US State Department, that kind of stuff. So yeah, you can get REITs everywhere. The reason I'm not too sure they're a good idea at the moment is two things. One, we just touched on, which is rising interest rates. Rising interest rates generally are not good for any kind of asset-backed security or property. Yeah, and the reason for that is that as interest rates go up, the cost of financing those properties goes up. The deal structure becomes more complicated. A lot more people the people renting the properties find that their economics are stressed. Mm-hmm. Yeah, so they can't necessarily afford to make all the rental payments. And quite often the rental payments or the lease payments are indexed to inflation, so they keep going up, and then people at the end of the lease just go, I'm handing the lease in, can't afford it any longer. So rising interest rates are generally not a great environment for REITs anyway. And the other one, which you just earlier identified, is work from home. Yeah. And work from home probably did benefit the big logistics guys. It didn't benefit the bigger bit of the market, which is commercial properties. Yeah. And we're recording this from London, and there's plenty of empty office space in London at the moment, although you wouldn't believe it from the increased rents. Yeah. So that work from home thing, and we don't. And the reason I would not do it on either at the moment, reason, which is interest rates and work from home, is that we don't know where either of those are going to end up. So what I mean by that is, it's a good chance interest rates could carry on increasing in the UK, and they could increase more than we think, and that could be bad for property. Mm-hmm. And we don't quite know how work from home is playing now yet, really.
I mean, the city at the moment is really buzzing. You're noticing it, certainly Tuesday, Wednesday, Thursday. And I'm just seeing it getting busier, so I don't know.
Yeah, but the interesting thing is that it sort of depends on the city. It depends on the type of office. So if you've got lower grade offices, they are tending not to do well. Higher grade offices with better renewables, energy costs are going up, so renewable power in them, yeah, they're doing better. Offices that have got more kind of amenity space, they're doing better. So it really does depend, which leads me to that investment trust versus ETF point. So an investment trust is effectively a closed-end fund, and a REIT is one of them. So it's effectively, I launch a company, I'm going to buy shares or property, and I'm going to call my company David Stevenson REIT, and I'm going to sell shares in it, and then you can buy the shares on the stock market. And I, David Stevenson, are going to run the REIT. That's what we call active fund management. I've decided which shares or which properties to buy. An exchange-traded fund is where effectively I buy shares in a company, so it's not dissimilar. But what the company does is it tracks an index, yeah, classic index like the S&P 500 in America, the FTSE 100 in Britain, or it could even be a real estate index, and there are REIT ETFs. Mm-hmm. And they track an index of REITs, yeah, and you basically buy the REITs in proportion to what's in the index. The reason why I would be cautious about REIT ETFs, and there are ETFs that invest in REITs, there are also REITs, just generally, is precisely what I just said, is it really does depend on what bit of the property spectrum you're looking at. Yeah. So, you know, if you're buying prime commercial centre of London, great, you know, that's probably doing all right. If you're at the moment buying big box logistics in the middle of nowhere, could be doing rather badly. Yeah. And if you're an index tracker, you're sort of always backward looking in that respect, because the index is always backward looking. Yeah. Whereas an active manager who's running a REIT could just say, no, I actually don't think sector A is a good idea. Yeah. So that's the difference really between ETFs. ETFs work brilliantly if you've got a broad market trend. You don't want a fund manager picking individual things. They work brilliantly at that. Where you've got a very specialist subsector, yeah, and where that subsector is undergoing lots of change, which have made the old rules not work any longer, like work from home, then ETFs can be more challenged.
Yeah, and I think it's fair to say, I've seen it through ETF Stream, you know, business we manage, that often the debate has been active versus passive, winner or loser. And I think it is possible to have a winner and winner in a balanced portfolio, because there are some managers of trusts that perform really well because they have a real knowledge and invested expertise into the companies they're investing within their trust. An ETF, as you say, for a broader picture, sector overview. So I just make clear that I myself have had both trust and ETFs at the same time, and I continue to want to do so. Yeah. I always get asked, because I'm the MD of ETF Stream, you must be entirely passives only, and be careful what I say, but I don't take that view. I believe in specialism, and I believe in... Well,
I've written a book on ETFs, and I founded ETF Stream, and I have investment trusts in ETFs. They work both. But interesting to say, if I made an investment in REITs now, I'd make it in a REIT, not an REIT ETF. Okay. And I'd invest it in certain REITs. But I think at the moment, I personally think it's still too early.
Right, okay. Fine. Too early for REITs.
Yeah, too early for REITs. We're getting, you know, any parent will know, kids will ask you, are we nearly there yet? We're not that far away from a trough, but I don't think we're at the trough. I think we need to see how those work from home patterns pan out. Okay.
On that point, just very quick answer. I wanted to ask, because again it's been in the media and it's something I'm keeping a track of as an avid investor. Is the end of the bear market rally nigh? And do you think we've had a bear market rally? I presume so.
Yeah, well, we technically haven't. I mean, the technical rule is it's got to go down by 20%. So the FTSE hasn't. FTSE 100 definitely hasn't. It's not been a bear market on that definition. I don't think so anyway. Let's correct me if I'm wrong. And the S&P 500, which is the big American index, I think is actually rallied. We're speaking here at the beginning of December 22. Has had a rally, and it's back above 4,000. I think it's actually down somewhere 18%. So technically speaking, we haven't really.
Okay, fine.
But the short answer is no. Okay. We're not near the bottom, in my view. And the reason for that is that most sell-offs if you believe that the sell-off is justified, and we've had a lot of reasons to believe that that sell-off is justified. Like we're going to enter a recession in the UK, certainly a slowdown in America. There's been energy crisis, there's inflation, all sorts of stuff going on. Rising interest rates, going back to what we talked about earlier. Most sell-offs, tend to be in the kind of 25 to 40% sell-off range, with the average being about 32. So we're still, in my book, a long way from a bottom. That's a cheerful thought.
Brilliant.
Right, so I thought we'd finish off by talking about international markets.
Yeah.
We've talked a bit about diversification before, but I thought it'd be quite interesting to say what the individual markets mean and why you'd invest in individual markets. So what do we mean by that? So most people understand if you invest in the US market, it's sort of got everything.
Yeah, very broad.
And in fact, if you look at an index that's got all the major markets in, developed world markets, the US markets are the biggest share by a country mile. Something like, and it depends, 60, 70% of the total value. So you can understand why people are very focused on America. But there are periods when the US market doesn't do very well relative to other markets. There is always a possibility that we might be about to enter that era, and in which case you need to think about other national markets. Now, people will then think about national markets, they sort of superimpose their kind of national characteristics over it. And that's sort of wrong, because all stock markets are in individual countries, just a collection of companies. And quite often the collection of companies is purely historical and accidental. So like the UK market is the FTSE 100, or people see it as the FTSE 100. Actually, the UK domestic economy is better captured by a thing called the FTSE 250. Yeah. But most international investors are the FTSE 100. And the FTSE 100 is slightly historical. It's got a lot of oil and a lot of mining companies in there. And that's because former imperial power, we've got a lot of those interests. So actually, the FTSE 100 is quite a traditional, quite cheap by most comparisons. So we use this idea of value versus growth. Quite a value oriented, because actually the companies in there,
for a very long time.
They've been around for a long time, and they've got deep asset bases, and they're not ridiculously overvalued. Now that's very different than, say, Germany. The DAX. And that is much more focused on two main sectors, really. A lot of export companies, sadly, to China, and industrial companies. So it's much more industrial. It's not overwhelming industrial. They've got quite a lot of finance companies in there as well, big German banks. So Germany is much more of a kind of export market. Mm-hmm. So traditionally, the German market's done well if China's doing well. And you see, as you move across national market, Japan is another example.
Often has been seen as a safe haven, right?
Well, yeah, interesting.
Bad times.
No, but yes and no. So at one point in the 1980s, it was the absolute go-go growth market. All these Japanese tech companies, doing really, really well. And then it crashed spectacularly, because of a real estate crash. And then it became quite safe haven because but again, it's very export orientated, And the Japanese market is very interesting because actually with the Japanese market, you can do terrifically well by investing in local shares. And it's actually now got probably the largest number of companies. They're not big companies, tend to be smaller mid-cap companies, that are worth less than the cash on their balance sheet. Let that sink in for a minute, There are lots and lots of companies in Japan that have literally been ignored, where they've got vast amounts of cash and their share price is below the cash.
Screams such opportunities.
There's an very famous investor called Ben Graham, who's now dead, but wrote the book on value investing.
Intelligent investor,
and he used to have these thing called Ben Graham nets, he'd call them. These are companies where they were, net of cash, net of everything, you were buying the company on the cheap. And there are actually loads of these in Japan, So value investors do terrifically well in Japan, Emerging markets, again, we talk about emerging markets as one big lump, but the Chinese market, which is very much more dominated by, interestingly, at one point it was dominated by big tech companies like Alibaba and Tencent. Now a lot of big state-owned enterprises, mainly banks, dominated, Whereas India, for instance, India's a very different market, again, because it's beginning to turn itself around from a more domestic market, where lots of big banks and consumer companies, there are now a lot more export companies there. So what I'm trying to get at is, each of these individual national markets has its own kind of characteristics, and you might invest in them for different reasons, So if you think that since stuff is going to be, you want to be more defensive, yeah, you might invest in more European companies and thus indices and markets. The UK is probably a good example.
Yeah.
If you're more growth orientated and you think that, you know, that growth companies are going to do very well, you'll probably navigate towards America, but you might actually go towards China as well if you think China is going to come out of COVID. So countries are quite a good way of actually investing depending upon your mood. Yeah.
Mood investors.
Yeah, mood investing. And I've known investors, big institutional investors, who've said that actually working out which countries are going to do well because of what's in their individual markets, and then buying the best country ETFs has been a winning strategy year in, year out.
So but an example of that being something that's of interest to me, so I believe it's still to be correct, don't fact check me directly, but I think India as a country has one of the lowest adoption rates of internet comms setup, i.e. meaning that
it's growing
more than
fast.
70% I think of their...
Might be less now.
Might be less, but when I checked, which granted maybe 6 months ago, an awful lot don't have access to internet.
Yeah.
That means there's a huge potential for the upside for communications, telecoms businesses and internet businesses to do well there. So I was defining that country, if you bet on that horse, so to speak, that will get its infrastructure right. Growth businesses in that area will do well, and that maybe where you would use an ETF play,
or ETF or an investment fund. Trust or investment trust. And spot on, because actually Indian equities are quite highly priced. They're traditionally, how do we measure that? We use classic measure, which is something like price to earnings. So I'm D. Stevenson Inc. I have worth £100 and my profits are worth £10. So my PE ratio is 10. Yeah, market capitalisation £100. Earnings is £10. If on the other hand I'm David Stevenson Inc., but I'm going to take over the entire world and I'm basically going to invade lots of small countries, so I'm going to do really well, and people think my £100 is going to be worth £200 fairly soon, they might bid my value up to £200, and I've still got £10 of earnings and my PE ratio is 20. So that in a nutshell is it. And actually that is India. So what's happened with India is that everybody thinks, for a lot of the reasons that you said, it's a great untapped market. That actually I'm happy to pay a higher multiple for Indian equities than I am for Chinese. A lot of Chinese companies, for instance, trade at single-digit PEs, 8, 9, 10. But that's because the sparkle has gone out of China for lots of reasons, and people are cautious about it. But they think India is a great growth market. Same with America. So if you go now and look at American equities in the S&P 500, the big companies, and you look at what their earnings are estimated to be for 2023, so next year, the average P is 20, which isn't cheap.
No.
Whereas I actually haven't checked, but I'm guessing the UK number will probably
single
be
digits.
Maybe not single digits, but probably about a 10 to 12, probably something like that. So, but that's because you've got a lot of oil companies, and those oil companies can make bumper profits one year and losses the next year. So there's a reason why quite often cheap is cheap. But what I'm getting at is, so countries can be a great way of playing your own long-term hunches. So if you're more growth orientated, you'll probably gravitate towards India. You'll gravitate to countries like Indonesia. Fantastic market, I think. I think Indonesia is the most interesting country around. Or the US.
I invest in C.
Oh yeah, which is
absolutely banking very heavily on Southeast Asia.
Growth. Is that Indonesian or Singaporean? I think it's Singaporean.
It might well be Singapore. I know it's focused,
but it's
Shopee
quite,
some of its
Indonesia,
and
absolutely.
Interestingly, taking on some of LATAM with taking on
Mercado Libre, exactly, which is kind of the Amazon of Latin America, has done really, really well. And it's almost like a single company you could buy Latin America for.
Exactly as I have done. I have both C and Mercado Libre.
So
funny enough, not Amazon, so I don't know if
So there's a kind of reverse where you can have a single company that represents a whole region, with Mercado Libre, which is a Brazilian company. Same with C. Or you could buy an Indonesian ETF, for instance. But if you think Indonesia's going to do, which I do, I think it's going to do fantastically.
Single country ETFs.
Because Indonesia's got phenomenal resources. It's got some of the world's biggest concentration of nickel, all the stuff that goes into batteries. A lot of it comes out of Indonesia. So you can play countries. And actually, we're speaking here in late 2022. in the second half of the year, one of the regions that's done terrifically well is Latin America.
Yeah.
Everybody else is basically chalked up lots of red ink.
Yeah.
But actually, Latin American equities and bonds have done really well. You'd have made a profit, on both actually, because actually the Latin Americans got ahead of the inflation curve. Their interest rates have been going up. Local currencies are reasonably strong. Brazil does quite well out of resources, big oil and gas country. So actually Latin America has been pretty good, actually. So what I'm trying to get at is you can use country funds, country ETFs, and even single stocks like Mercado Libre as a way of expressing how you want to invest for the long term. It's not just about America.
And to round off, I wonder if we'll be seeing a LATAM versus Europe final in the World Cup with your Brazil or Argentinas against your Englands. So
Unless this goes out by the time when France has won.
Yes, indeed. But even then, flying our European flag, as I still try to do, it'll be interesting. But yes, very insightful, David.
Lovely. And we'll be back in a few weeks' time.
Ciao.
See ya.